Looks like we're going to have to wait just a little bit longer. Janet Yellen and the Fed decide not to raise rates as many suspected that they would. Here to discuss this are Gillian Tett, U.S. Managing Editor of the Financial Times, John Authers, Chief Investment Commentator. Gillian, everybody's been waiting for this moment. Janet Yellen decided not to do it. What do you think?
We're back to the waiting game. And in some ways, I think this is actually quite damaging because the markets were psyched for some rate rise. Of course, after the Chinese turmoil, there had been expectations rising. The Fed might step back. But the reality is that the employment data is where the Fed said it wanted to be. The growth figures are strong. There were a lot of reasons for the Fed to act. And by delaying it yet again, it's helped people to start thinking, well, maybe, just maybe, the Fed doesn't mean what it says, that it's looking at the real economic data in the US. Maybe it's basically becoming hostage to the fortunes of the global economy and global markets. And that is probably not a great place to be.
John, what do you think?
I can't disagree with too much of what Gillian just said. The statement, the whole package was right at the very most dovish end of what I thought to be possible. It really is what it sounds like when doves cry. There was no mention of the word China in the statement because there can't be for diplomatic reasons, but plainly the statement was saying because of what's happening in China, it now looks like we've got that much more risk of a deflation, so we can't move yet, guys. That means if things continue to get worse in China, which is perfectly possible, the possibility of months, years more of ZERP gets back onto the table, begins to seep into expectations.
But isn't there a sense in which this doesn't necessarily reflect the kind of cosmopolitanism on the part of the Fed? In other words, they're genuinely worried that these global developments, these big global disinflationary pressures, will feed back into the U.S. So I, too, was surprised by how often it was mentioned and how much it was emphasized. And yet I think there's some sense in it. In other words, there's a worry that the U.S. isn't isolated from these pressures. Gillian?
Well, there certainly is a risk of that inflation will stay low for some time, partly because oil prices have been falling. At the same time, you've got a strong dollar, but also because it does seem as if some of the core relationships in the economy are shifting as things like technology take hold and change the price dynamics. And that leaves Janet Yellen in a situation of being like a pilot of a plane where all the controls on the dashboard, the radar, the altimeter, aren't actually working as she would normally expect. She's flying partly blind because the economy is not behaving as we would expect right now. But to my mind, the bigger issue is this. The Fed now has been running a so-called emergency policy. QE, remember, was an emergency policy now for a number of years. And what was supposed to be a crisis-fighting measure has now become the norm. And so the question everyone should be asking is this a norm we want to live with indefinitely? Because by delaying again, the Fed really has raised its perception that it is actually quite reluctant to move quickly if anything goes wrong on the world stage. And there's actually a lot that could go wrong in the coming months.
John, inflation is half the Fed's mandate. It's been missing to the downside of its 2% target for the better part of by quite a lot. It's been missing, though, for the better part of a half decade now. What does it do when the real economy is performing about as well as it would want to? That the unemployment rate is now within its range for what it believes to be the natural rate of unemployment, but inflation has been off for a very long time. Unclear that it's going to be moving back towards 2% anytime soon. What do you think?
Well, there's a good argument that it missed its opportunity to start raising rates about a year or so ago. The risk, which Gillian, a former Tokyo bureau chief, knows more about than me, is Japanification, plainly, that we're stuck here at these kinds of levels. If you get the kind of powerful deflationary force coming out, most obviously from China, that looks possible at the moment, then you're going to be caught in a logical trap for a long time. It's a concerning state of affairs. You can see why they wanted to raise rates just to prove that they could, just to send that signal. The fact everybody knew they wanted to raise rates, everybody could see why they wanted to raise rates, somehow or other makes the signal that they've now sent seem that much more negative.
But also, on the point of inflation, let us remember that tradable goods inflation is not rising right now. Asset price inflation is very significant. And one of the great intellectual contradictions in the Fed's policy in the last couple of years is that it seemed to quite deliberately target asset price inflation as part of QE. And yet now it is only looking at the consumer price index. So frankly, to my mind, it should be actually doing a joint view of the landscape, looking at both asset price inflation and consumer price inflation, because actually it's the asset price inflation that created the problems back in 2006 and 7, and I suspect if they carry on this indefinite QE path, we could be dealing with asset price questions going forward as well.
And asset pricing questions are also, almost by definition, inequality questions. If asset price inflation is going up and other inflation isn't, that's good for the rich people who have assets and not for everybody else. As we can see from the political season, that is a real problem. The political pressures on the Fed could begin to rise.
Final question for both of you. Janet Yellen has been at pains to convince everybody that the date of the first rate hike doesn't quite matter as much as the subsequent path of rates, right? Not necessarily convincingly, given the way that traders and economists have been anticipating that first date, and maybe it does tell us something about the Fed's preferences. So the final question is this: how much does that first date actually matter, Gillian?
The Fed's trying to have it both ways. They're saying they're data dependent. That's their new mantra that they keep chanting like groupies. And yet Janet Yellen also seems to think she's time dependent as well. You can't be both. And if she wants to be data dependent, then she will probably need to go sooner rather than later, and she would like to keep control of events and persuade everyone that it will be a very gentle upward slope. In reality, though, I suspect the longer she waits, the greater the risk of an accident later on, in which case she will lose control of that slope pretty quickly, and it won't be as gradual as the Fed would like to think.
John, you agree as the Fed contradicting itself somehow?
Yes, there is also the sheer mechanics of the fact that there is the risk of a financial accident. We don't know what will happen to the bond market with the problems that there are with liquidity in the bond market. We need to find out. The only way we can find out is when they actually do it. The longer they postpone that moment, the more concern there will be about it.
Gillian Tett, U.S. Managing Editor, John Authers, Chief Investment Commentator. We'll see you both again in 6 weeks or so?
I fear as much.
Probably every month for the next 6 months.